With 4 minutes left before the market closes, we need to say this: stop the insanity. Marco, be quiet. And no, we are not talking about the terrifying global headlines. Are we setting ourselves up for another correction? Joining me now, Don Schreiber, WBI Fund CEO and co-portfolio manager. You say this has nothing to do with the exogenous events and the worrisome global headlines.
Well, what we have right now is people focusing on, for a very long time, this backstop that we have that the Fed gave us of QE, quantitative easing, and low interest rates, zero interest rate policy.
Okay, I've heard this preamble a million times. We're
Yes.
going to have a huge correction, but you're still sticking with this prediction.
You bet. 2014 earnings started to decline quarter over prior year quarter, and they're accelerating on the downside. This quarter, the third quarter, looks to be about a minus 14 or 15% over last year at this time. Stocks typically don't continue to rise as earnings continue to fall.
Okay, but see these divots. Could we go back to the year-to-date S&P, and you will see that same divot that you saw with the Nasdaq that happened right around the time that China had a tantrum in its stock markets. China is rebounding just a bit, and what do we see? We're pretty much where we started before that point. It's almost even there on that thing. So why should I worry now that correction didn't even hold?
Well, that wasn't really a correction. It was a 10% drop in value.
That sounds like a correction to me, but go on.
Okay, well, we expect a much more significant price adjustment based on this huge gap between fundamentals and where we are in terms of prices. That tends to reconcile. Usually it takes about 4 quarters of negative earnings for the market to wake up and realize, investors to realize,
4 quarters, okay,
things aren't so good.
So what's the strategy?
The strategy is to continue to invest only in those stocks who have positive trends. You can still find stocks that have decent value and also have growing revenue and growing earnings. About 30% of the S&P companies still fit that criteria.
That's not a huge percentage, but you did the work for our viewers. You've got Hasbro, Webco, Fair Isaac. Those three, you say. Fair Isaac is, by the way, FICO, but those three fit into those parameters.
They do. They have really strong earnings growth quarter over quarter. They have revenue growth quarter over quarter. And these are the kind of companies that we need to be looking at. They're still pretty pricey. Most stocks are still selling at relatively high PE, so it's a very higher risk play. You've got to be careful, and you've got to have some risk mitigation. We believe that risk mitigation includes having stops under your securities if things start to turn.
Yeah, because you might be busy that day.
Yes.
You might be putting Purell on your chicken. But Don, as we look at what's going on here, we know that the Federal Reserve is going to meet the 15th and the 16th of December. Should they raise rates? Will they raise rates?
Well, I think it's really wrong-minded for the Fed to raise rates. Typically, they only raise rates when the economy coming out of a recession is starting to overheat. 5, 6, 7% growth rates. We're still 2% growth rate on GDP.
$3.3 billion he's got, so I'm listening to you right now, but we'll see what happens. Thank you so much. It's great to see you.
Thank you.
Don Schreiber.